I'm just wondering, is it time to reprice risk, or have we been here time and time again that the market's kind of used to it?
Good morning. So I think the market is getting better at discounting what would appear to be yet another new normal, this time a geopolitical new normal of increasing tensions between the world's two hyperpowers and the potential for what was previously trade tensions to morph into tech tensions and potentially everything tensions over time. But with that, of course, we've got to balance that against what is still a very supportive policy setting from the world's policymakers, not least the central bankers.
Ben, you say that you are neutral equities. Given the high valuations in bonds relative to stocks, why shouldn't we see a rotation from bonds to stocks going forward?
I think that's right. So one of the reasons that we've stayed neutral even during the severe downdraft, so that sounded, neutral sounds a rather uninspiring call, but going back to the end of March, it was, I guess, rather more controversial than it is now. But we think, as is so often the case, trying to avoid the behavioral mistakes that feel so right of selling low and buying high. And for us, we still, when we blend the economic opening up, which of course is going to be patchy and uncertain, and there are risks around so-called second wave and all of those things, but nonetheless, it looks to us like we're in the opening up stage of the situation. That combined with, as I mentioned, extraordinary policy support, including from the MPC at the end of last week, for us suggests that investors should remain invested in equities. And as you mentioned, we at the BlackRock Investment Institute have an overweight specifically in the US and in this region, Asia ex-Japan.
Ben, is that policy support from the Fed in the US, is it enough to inoculate the US economy in the event that there is a second wave there, particularly when you see how badly the virus has been handled by the administration in the US and the piecemeal approach amongst some states and governors?
I think this is a very difficult situation for politicians all over the world because it's very hard to solve, on the one hand, for the, of course, very important priority to keep people safe, but on the other hand, to try to open up and have an economy that we can all step back into. And to some degree, I think that is an insoluble problem. So perhaps unusually, I do think we should feel a little bit sorry for politicians trying to balance these two very difficult situations. Now, I think what we've learned is that policymakers are willing to act at a scale and a pace that we have not seen in modern history. So I think if we do, unfortunately, see some sort of second wave come through, then I think both on fiscal and monetary, and not just from the Fed, but in Europe, in the UK, in this region, I think we will continue to see more policy support as much as is needed to create that bridge that people are talking about from before the virus to after the virus. So as I mentioned, we've got an economy that we can step back into, most importantly for people to get back to work and to some degree at least a return to normal life.
And switching focus to this part of the world, Japan, at what point would you be interested in equities in that country? They've started, and we've seen that today, lifting those emergency measures. Are you seeing anything that brings you back into the Japanese market?
Yeah, look, so we are, at the BlackRock Investment Institute, we are currently underweight Japan equities. And one of the key reasons for that, of course, has been Japan is very geared into the world through its export sector. So now, as we're starting to see, I should say, very early signs, but nonetheless, it appears to us some early signs of green shoots with flash PMI in developed markets last week, Korean exports, Taiwan exports, just some signs that we are in the green shoots of the opening up stage. Then that obviously would benefit Japan accordingly. And secondly, we had an unusual and interesting joint meeting with the BOJ and fiscal authorities on Friday. Now, Japan, of course, is a lot more, let's say, advanced in the unorthodox policy than the rest of the world. But nonetheless, Friday perhaps showed that there is the capability, even in Japan, to do a little bit more. So we're currently underweight, but as I say, if the world, all being well, normalizes in the weeks, months, and quarters ahead, and it turns out that there is the capability to do more self-help, if you will, within Japan, then that would be, it seems to us, a more constructive framework for Japan equities.
Ben, for a very long time, if you want exposure to China, you play it through Hong Kong. With what's happening in Hong Kong, has that scenario changed, and how best to get exposure to China?
Well, I think as a matter of pure maths, it's actually become more true over time. So in rough numbers, going back a decade or so, around 60% of revenues for companies listed in Hong Kong came from Hong Kong. That number's now down to around 30%, with a lot of that change now coming from onshore in China. So in terms of pure revenue exposure, Hong Kong is more exposed to China now than before. But with that being said, of course, that's being obscured by the political difficulties, which I think are going to continue as we head into, obviously, domestic elections in Hong Kong in September. And to some degree, Hong Kong, one assumes, will continue to be a flashpoint in the broader geopolitical conversation between the U.S. and China, which one assumes the rhetoric around there is going to stay rather heated, at least until November the 3rd, when we get to the U.S. presidential election.